Starting a business is exciting, but there's probably an elephant in the room. How will you fund it? It can be daunting and overwhelming. Today, I'm going to make it simple and show you my top tips on how to fund your business successfully. It's not always easy to finance your business, but it's one of the most important parts of starting a business. And there are multiple ways to do so. Some might be better suited for your needs than others. Understanding how each one works and what's good or bad about these different business financing options can help you narrow it down and find what works best for you, because there is no right answer. It's all about what works best for you, your new business, and your current financial situation. So let's talk about 8 common methods of funding your business. The pros, the cons, and everything in between, so you can figure out your best option. Number 1, savings. The first option for financing a startup business is using your own personal savings. Some of you have maybe been thinking about this for a long time, so you've been saving up for this moment. This is also what we like to call bootstrapping. You are doing it all on your own, and there is nothing wrong with doing that. Starting a business using cash pulled from your own assets means you're not going into debt right off the bat. You've had foresight and means to think about this in advance and plan. However, you do have to be ready to risk that money. Using your own cash for your small business financing is risky for you personally. If the business doesn't work out, then you're out of the money you're invested in. If you choose this method, you need to go into it with the understanding that this money could be lost. Also, your personal savings may only be able to take you so far if you don't have a lot of assets to draw from. Running a business is expensive, and new costs and things you didn't think about will pop up every single day. So you may also need to supplement your investment in the business with financing from other sources. And it's not always easy to save up. Depending on your income, bills, and financial situation, it may not be in the cards for you to save up. I think this is a great option, but if it doesn't work for you, don't worry, we have other options. Number 2, credit cards. Credit cards can offer convenience for your business if you need a way to charge expenses and pay them off later. At the start, you won't have any income or sales yet. So credit cards are a great way to help lay the foundation of your business and pay it off once sales start rolling in. There are plenty of credit cards for financing businesses that can pay you something back in the form of points, miles, or cash back. If you go this route, be sure to shop around and find the best deal. Also, don't forget to look at those interest rates and ensure you aren't overspending for points you may never use. If you're considering a credit card for financing a startup business, make sure you understand the difference between personal and business cards. Whether you're eyeing a personal or business card, read the fine print. Specifically, pay attention to regular and introductory APRs for purchases and balance transfers, annual fees, rewards program, and card benefits such as premium travel benefits or shopping protections. There are tons of options out there, and it all depends on what you need them for and what you're looking for. So weigh out the options and don't let hidden fees sneak up on you. Remember, when applying for a business credit card or a personal one, your credit score matters. The better your credit score, the better your odds of getting approved and getting a low interest rate. Number 3, friends and family. This one can be a little scary, but asking friends and family to back your business financially is something you might consider if you don't have personal savings you can tap into, or you're on the fence about using credit cards for financing. The upside of asking friends and family to invest in your business is that they may offer you better terms than a lender, assuming they're lending you money and not gifting it. What you have to keep in mind when borrowing from people you know is how likely your business is to take off. Having your friends and family's money on the line could add added stress on you to succeed, which could be good or bad depending on how you feel about the level of extra stress. This ultimately means that if you don't have the cash flow to repay these kinds of personal loans, that could hurt your relationships. So consider this when making your decisions, and make sure that your friends and family members are only giving up money that they feel comfortable parting with. Number 4, small business associations microloan programs. If you are in America, the Small Business Administration sponsors numerous small business financing programs. But microloans tend to be better suited for funding a startup business. There are tons of organizations and community initiatives that will help fund small businesses in your local community, whether you are in America or around the world. You just need to look around and do your research. But microloans are a good financing option to consider if you don't need as much money to get the ball rolling and you don't want to take longer than 6 years to pay back what you borrow. Another advantage of using a microloan is that you are more likely to get competitive rates compared to what you might find when borrowing through a traditional financial institution. The options here will really depend on your niche and your local area. But dig around online and see what is offered for a business like yours. You may find that these small loans are more readily available, and many other small businesses may be unaware of this. Number 5, angel investors. Angel investors and venture capitalists are two options for how to finance a business that doesn't involve borrowing money. Instead, you're essentially getting funding from individuals or companies that invest in startups. They invest because they believe in your business. Working with angel investors to finance a business has some key advantages. Most importantly, the money you're getting doesn't have to be paid back. That means if for some reason your business doesn't take off, you aren't left with a mountain of business loan debt to repay. Your slate will be clean. When you accept financing from angel investors or venture capitalist firms, it's typically on the condition that you offer your investors an equity stake in your business. In other words, you're giving up some of your ownership and control of the business in exchange for an equity investment. If this is something you're not comfortable with, this won't be a good option for you. But this is a great option if you are comfortable with that, because there is less stress and stake involved over borrowing from friends and family. Your angel investor is most likely not a close relationship. So if your business doesn't succeed, it won't be too detrimental if this relationship sours, and you won't owe anything as well. Number 6, crowdfunding. Crowdfunding has really blown up over the years, with websites like Indiegogo, GoFundMe, and Kickstarter. The options are endless. This is a great way to raise money from a group of individuals to fund your business. Also, unlike sourcing funds from your friends and family, the pool of people is larger, which means that they can fund you with smaller amounts, making it more feasible. Like I mentioned, there are tons of crowdfunding platforms that cater to helping startups get off the ground. and more general crowdfunding platforms you can use to tap into working capital. With this, you can create a proposal on the platform detailing how much money you need, your goal, and what it will be used for. Investors view your proposal and decide whether or not they want to make an investment in your business. Some crowdfunding platforms are reward-based, meaning that instead of paying the money back to investors, you offer them a reward instead. For instance, if you're selling a product, funders can purchase different bundles of said product, usually at a discounted price, for being a funder. Other crowdfunding platforms are peer-to-peer lenders, meaning working capital is raised from the crowd, but it must be repaid to investors like any other loan. This is a great option, but you also need to ensure that your business idea is something that the general public will be interested in investing in, and that there will be enough demand. This kind of funding usually does best with consumer products where a good video ad can pull them in. It may not work as well for a service-based business. Number 7, business loans and lines of credit. Business loans and lines of credit are two of the more traditional options for how to finance a new business. I've already mentioned microloans, but you could also look into short-term loans, long-term loans, development loans, and equipment financing. One thing to keep in mind is that some business loans may be more difficult to qualify for than others, especially if you have a brand new business. And you may have a harder time getting a term loan from a bank, whereas an online lender may be more flexible in offering financing to new businesses. A business line of credit could be easier to get approved for, but it works a little differently than a loan. With a loan, you're getting a lump sum of money that you can use to fund your business. You then repay the loan according to the repayment schedule set by the lender. A line of credit, on the other hand, can be a revolving credit limit similar to credit cards. You draw on your credit line as needed to make purchases for the business, then repay those amounts. As you make monthly payments against your balance, you free up available credit that you can use again for future expenses. This is a great option and one of the more popular ones. Number 8, factoring. Factoring is something you might consider when financing a startup if you've already have some customers and cash flow coming in. For instance, if you started your business as a side hustle and now you're ready to move over to full-time, with factoring, you're leveraging your outstanding accounts receivables to borrow money for your business. A factoring company lends you money based on the value of your receivables. Depending on how the financing company works, you may repay what you borrow as invoices are paid, or the lender may collect payment directly from your customers. This kind of small business financing option is something to consider if your operating history and credit history don't allow you to qualify for other types of financing. The downside is that factoring can get expensive since lenders may charge fees rather than a standard annual percentage rate. There are tons of financing options out there for small and startup businesses. Not one is better than the other. It all depends on you, your personal business, and finances. Speak to a financial advisor, do your research, and figure out what makes the most sense for you. Deciding how to finance your business can depend on several factors, including how much money you need, how good your credit is, and whether you're comfortable with taking on debt or exchanging equity for funding. I hope you all enjoyed this video and found these tips helpful. Let me know in the comments how you finance your business. Let's share ideas. Don't forget to like this video, subscribe, hit that bell button, and let's grow together.